Hello guys, so today I'll be sharing with you the top 4 deadly mistakes that you should avoid in your trading. These are probably the worst mistakes that will end your trading career very slowly without you even noticing. So there are things that as long as you keep repeating them, they'll keep affecting your trading performance. And if you're doing these things slowly by slowly, you might not notice their effect until time passes by. That's why I've said you want to avoid these mistakes in your trading. So first mistake is inconsistency. Now inconsistency is very broad. For instance, this could be inconsistency with your trading strategy or your trading approach, meaning you keep switching your strategy every other time or every other day. So today you're using this approach to enter the market, tomorrow you try a different approach. So you never give one approach the time to actually master it and to see its results in the market, because the more you keep switching your strategies, you keep increasing the randomness of your performance, and you automatically limit the possibility of seeing any success from one system. Because the thing is, most systems work in the long term, so you just can't keep changing a system every other week, every other month. You need to work with one system. Another type of inconsistency is with your trading pairs or instruments. So you're very undecided and you keep trying new pairs every other time. You've not selected the specific pair that you are trading and you are consistent with. Again, this way you keep increasing randomness in your performance, because you're going to come and make money on one pair, you lose money on the other pair. Then instead of continuing to trade the same pair consistently, you again switch and you go and try to look for a different pair again from your watch list. So you want to keep trading the same pairs consistently, because in case you take a loss, then you do lose on that trade very, very well. But in the case you find a profitable trade eventually, it will come and recover the losing trades. So you want to select your best pairs that are profitable and stick with them consistently, as long as you've already proven that there's an edge around the pairs that you are trading. Still on the first point, another form of inconsistency is with your risk management. So today you are risking 1%, tomorrow you risk 3%, the other day 10%. The problem of this is you'll have an imbalance between your winners and your losers. So one day you'll be losing less, another day you make a lot of money, another day you lose even twice or thrice. So there's a lot of inconsistency. While the idea is you should be risking the same amount of money per trade, so that if you're risking 1% and your risk to reward ratio is 1:3, it means whatever you are risking, if you lose that 1%. If it goes to your profit, you gain 3%. But now if on your next trade you try to risk now 6%, then you lose, you end up losing so much more than you even made, and you go all the way back to drawdown. So let's say you do have something like this, which is actually your trading curve. So today you risk 1% and let's say you make 3%. Then tomorrow you come and decide to risk something like 10%. And unfortunately the trade goes against you. You'll end up losing your 3% plus an extra 7%, and you go very, very deep in drawdown. The problem of going deep in drawdown is that you can now no longer continue risking the 10%. So you'll be forced to cut down your risk to something like, again, 0.5, 0.2%. So even if you make profit, the profit becomes very, very little. So what I'll advise you is just stick to the same risk management, because if you stick to the same risk management and you are consistent, what happens is if you make profit, you make, assuming you're risking 1%, you do make 3%. Again, just using random figures. In the case you lose your next trade, you only lose an extra 1%, but you're losing 1% from the 3 that you've already gained. If you lose another trade again, you lose another 1%. So out of the 3% that you gained, if you lose 2 trades, you've only lost 2. So you're still up +1, because it's 3 minus the 2 that you've lost. In the case you find another profitable trade with your 1%, for a 1:3 risk to reward, again you go up to 3% and your curve continues going up. But now the problem is when you start to get tempted and you do a silly mistake like assuming that you can now risk more, then you decide to now risk something like 4 or 5%. So if you continue like this, you'll realize your curve will be smoother. You'll have ups, you'll have downs, but it will be going up consistently, than doing a mistake of risking something like 10%, then it goes against you and you lose everything and go back to negative. So you don't want to do that in your trading. You want to really maintain a smooth trading curve. And just before you continue, let me share with you the website that I do use to follow up with the economic news in terms of fundamentals, and it's called FastBull. It's quite a unique platform with very many features. For me, I use a lot the economic calendar, because you all know it's important to be aware of what's happening in terms of fundamentals, especially before you enter the market, just to make sure you're not trading during the wrong market conditions. So with FastBull, you can come and customize your time here. Once you're in your economic calendar, you can come and also customize to only receive news from specific regions. Like for me, I've only selected to receive fundamentals from the pairs that I'm interested in, and all the rest you can unselect. If you click on the more button here, you have the chance to filter to only receive high impact news. So we have so many fundamentals, but it's always necessary to only focus on the ones that have a significant impact. So you come and select the 3 stars here, the ones in red. And then once you confirm, it will apply in your calendar and you'll be receiving economic data from all these markets. You can also go back in time and select the specific date that you want to see the news. So I use this a lot when I'm back testing. If I want to go to, let's say, last year, January, I can just come and click here, select the year that I want and the specific date, and I'll be able to see the specific news that were released on that day. Without forgetting, it's very flexible. It has a mobile app, so it will be very useful, especially when you are outdoors and you still want to follow up with your calendar. I have many other nice pages like this one of analysis, which has many articles in regards to different markets, different predictions from various analysts in the market, and the 724 page, which shares macroeconomic data from any market you can think of, be it futures, stocks, Forex. Finally, they are hosting an expo in Dubai. Here are the dates. If you want to register, all the links will be in the description. The second deadly mistake you want to avoid in your trading is closing trades prematurely. This is something that many traders take lightly. Myself, when I was struggling a lot in my trading, when I started doing my journal, one of the things I realized is that my performance was bad because I used to close my trades very early. And as you remember, I told you, when you're doing these mistakes in the live market, you might actually never notice the problem. You might never think you're doing something wrong, but over the long period of time, they'll slowly be affecting your ability to become profitable. Closing trades prematurely goes both ways. That means whether your trade is in profit, as long as it hasn't hit your target, you should not close it prematurely. Whether your trade is in loss, as long as it's not hit your stop loss, you should not close it prematurely. Let your trade run to the final target. For losing example, it simply means you are buying and you want the market to go up, right? However, again, you're risking $100, targeting 300, 1:3. You open your trade, it's playing very well, but it starts to go against you slowly by slowly. Your stop loss is at $100, but it hasn't been hit yet. So the more the market is approaching your stop loss, the more you get frustrated and you decide to close your trade prematurely. So even though you are risking $100, the trade is maybe floating at about $80 or $90 negative, but you decide to close it prematurely because in your mind you are convinced that this trade won't go to your favor. So after you close it here, surprisingly, most of the time it again, so instead of doing a 1:3 on this trade, you closed at a negative prematurely. Now, even if it doesn't necessarily hit your target, it might still come and do maybe even over half your target before it starts to reverse. In this case, it means that even if it doesn't hit your target, you still close at a break even. Now at a break even, it means you lost nothing. So either way, this trade could have been a 1:3 or a break even, which all of them are better, but for you, you closed at a negative simply because you've judged the market prematurely and you didn't have the patience. So the third deadly mistake that you do want to avoid in your trading is trading without a plan. Now there's a difference between knowing what you're doing in the market and actually having a very exact plan. There are traders who have an idea of what they're doing. They know how to read price, they can tell you where the market is likely to go in terms of top-down analysis and all those things, but they don't have a very defined plan in terms of having a criteria of the things they must see before they enter the market. The whole idea of having a criteria is that you want to avoid taking trades randomly. You want to avoid trading anyhow. You want to avoid over trading. You want to make sure you're trading only during the best conditions. And how do you know this? It's by actually studying your system or your trading style and coming up with a step-by-step plan that assists you to get entries at the best time in the market and also tells you when to exit the market. So you want to make sure you have a plan. Don't just assume that because you understand how to read price action, because you've been making profit for maybe 1 week or 1 month, it automatically means that you have a long-term edge in the market. You want to have a plan, you want to define it, and you want to be referring to it before you enter the market. Like if you look at my setups, all of my setups follow a very specific plan. Nothing is random. I must see very specific criteria before I determine that this setup is valid. And also when I enter the market, my criteria also tells me when to exit. So the fact that I exited here was not guesswork. I didn't just exit here because I thought it was a good place. I have a system that tells me exactly what to do. Trading without a plan is very risky because sometimes you're going to be lucky and you will think you know what you're doing, but you have no plan in the market, it won't take you so long before you realize that your performance is actually going nowhere. On the other hand, someone who has a plan, you can find them even losing in the market for a whole 1 week or 2 weeks, but they're still taking their trades systematically. They have no stress, they have no pressure, simply because they do have a defined plan, they do have a system that they are following, and they have confidence in that system because they have already proven that it works in the market. So without a plan, even if you make profit for 1 week or 1 month, it really doesn't matter because you are just lucky, and it's just a matter of time before you actually give back those profits in the market. It's only you who think that you are doing well, but within the next 1 trading week, 2 trading weeks, you will end up giving back the same profits in the market. So you really want to have a plan that is defined and will assist you to know the best times to enter and exit the market. The final deadly mistake that you want to avoid is chasing huge returns. Now, there's nothing absolutely wrong with having huge performance in the market. If you have a big month, that's actually nice. But the thing that we are against is constantly going to the markets with the intention of trying to chase that huge performance. So the reality is your performance should only be a function of what your system has given you. So what you need to do is execute your system, take the trades according to your plan, let the probabilities play out. If the month ends as a huge month, well and good. If the month ends with just barely 1%, well and good. If your month ends at a break even, again, well and good. As long as your system is working in the long term. But don't go to the market with the intentionality of this month I must make a certain amount of money. When you do that, you're going to pressure yourself. You're going to start taking random trades. You will be tempted to risk more. And as you know, as long as you're trading emotionally with all these things, it's just a matter of time before you end up blowing your account within just a few trades. I've seen a number of traders online who have done huge performance, like 30%, even in the prop firm space. But even when you watch their interviews, you hear them say that when they were approaching their month, they didn't even know that they were going to make that percentage of return. It wasn't something they were planning for. They just probably had a certain season where they had winning streak, and most of their trades were just playing out, and they ended up making a huge return in the market. But it's not something you go after intentionally. So that's it for this video. You can also share your thoughts on the mistakes you think traders should avoid. Otherwise, I'll see you in the next video.